Hello viewers, welcome to my YouTube channel, One Raj Kamal. As you go through this video, please do subscribe to the channel and also press the bell icon so that you can get notified every time a new video comes out. S&P 500 has seen the worst start to the year in the first 6 months in 2022 for the last 50 plus years. This year, the first 6 months saw a decline of 20.6% in S&P 500, and this is the worst since 1970 when it declined by 21%. There have been only two more brutal years where the first 6 months were even worse. 1932 when S&P 500 was down 45.4%, and 1962 when it was down 23.5%. So a real painful start to the year, and we still have to see how it goes forward for the remaining 6 months of 2022. If you see the heat map of sectors, that makes it much more clear on why there is so much pain and carnage. First of all, it is across sectors. And then more importantly, sectors which have a higher representation in S&P 500 have actually got hit the hardest. See this chart. Tech is down over 26%. Communication services down over 29%. Consumer discretionary over 31%. Financials over 18%. So even if energy did better and was positive 30%, and utilities and staples held up better than some of the other sectors, because their contribution to S&P 500 is lower, overall there's been much pain, and many people are seeing deep reds in their portfolio. On a positive note, July 1 was a bullish day, and S&P 500 rose 1% or over 1%. NASDAQ was up 0.9%. So a positive start to the second half of the year, whether it was just some positivity coming because of the 4th of July celebrations, or very oversold conditions, or something more sustainable, that we will have to see. If you look at the crypto markets, the carnage continues. Voyager Digital, a major crypto broker in the sector, suspended all trading, deposits, and withdrawals. Three Arrow Capital has been ordered liquidation by a court in British Virgin Islands. BlockFi is reportedly in a fire sale situation, and possibly to FTX. CNBC and Bloomberg were reporting fire sales for BlockFi, which obviously they have denied on the Twitter channel, but there is still a lot of smoke. Similar smoke on Celsius and what its state is going to be. And if you listened to the FTX CEO, Sam Bankman-Fried, he actually said that there were many exchanges which were likely going to go down, and this is all driven by excesses and bad actor activity that has been going on in the sector for the last couple of years. Too much free money leads to very high quality, good technology also seeing bad actors at play, severe excesses and behavior which then comes down unraveling whenever there is a meltdown in prices, as we are witnessing currently. One other important thing came out in the last 2 days of the week. So on Friday, Atlanta Fed came up with a GDP projection of minus 2.1% for Q2. And this prediction came just one day after a prediction of minus 1% that came on Thursday. So basically, Atlanta Fed projecting a sharp decline in GDP for Q2 in the US. And as we have discussed in the past, the first half is projected to be negative at about minus 1.6%. So effectively, the US is already in a recession. You could call it a technical recession because 2 quarters of negative GDP growth is defined as recession in the US. This is a bit unusual because labor markets are tight and unemployment rate is very low at about 3.6%. That's at least the number that we saw in May 2022. So what could be causing this? And I think all fingers will point at inflation. Surging prices, be it food, energy, housing, rising costs of mortgages, credit cards, all of this have caused a decline in the real personal surplus disposable income. You can see in this chart from advisor perspectives that the real personal disposable income of an average American is declining. And when that declines, discretionary spends go away, reduce. People don't want to spend on things which can be avoided. And that leads to weaker economic sentiment. And we all know that the US is a consumer-driven economy. So whenever the consumer pulls his or her hand back, that's when markets begin to show a weaker economic climate. That's what we were seeing from the start of this year in terms of prices. And now data shows that Q1 and Q2 are actually negative GDP growth. So despite tight labor conditions, surging inflation possibly has caused the recession or 2 quarters of negative GDP decline that we are seeing in the US. Unusual, given that unemployment rates are very, very low. So what could happen going forward? Well, the Fed says that they will continue to tighten. They will keep increasing the Fed funds rate, and they will also keep shrinking the Fed's balance sheet. If you look at the CME Fed Watch tool, that actually predicts that the Fed funds rate will be about 325 to 350 basis points by December this year. So significant increase in Fed funds rate projected. Now, with this happening, what should one expect? There are some people who will actually say that PCE core inflation is abating. So the number for PCE core inflation actually came down at 4.7% in May compared to 4.9% in April, and much lower than 5.3% in February. But we all know that PCE core inflation is actually without considering energy and food prices. These prices are outside of Fed's control. There are supply side factors which are contributing to increase in these prices, and I don't expect these prices to come down anytime soon. With very low unemployment, continuing total inflation levels, is there any reason for us to believe that the Fed will change its course of tightening, increasing the Fed funds rate and shrinking the balance sheet? I don't think so. I mean, normally in the past, Fed has changed its course from a tightening path because the market has collapsed or something has broken. Now, the markets have already collapsed. All the three major indices are in bear market territory. So the only thing that can make the Fed change its course is if something breaks or if something collapses. Till then, the Fed is likely to continue on its course of increasing the Fed funds rate and shrinking the balance sheet. And by the way, that has been happening at a very rapid pace. The increase in Fed funds rate was about 50 basis points in May, 75 basis points in June, and there is an expectation of 50 to 75 basis points in July as well. These are pretty steep changes in the Fed funds rate. So if something breaks and if this plays out in this way, then that would also signal another recession. Nothing will break if economic conditions aren't really stressed, and very stressed economic conditions mean another recession. If you look at certain indicators such as the 10-year minus 3-month yield curve difference, that is down to 1.15% in early July compared to 2.2% in late May. So steep decline over there. There has been a significant decline in the 10-year yield, as well as a decline in prices of commodities and energy over the last few weeks. So all of this reflect the market's feeling that economic conditions are going to deteriorate. So what should one expect? Well, there is a likelihood that there might be an improvement in the scenario, and we might see 1 or 2 quarters of positive GDP growth. But given that there isn't sufficient likelihood of the Fed changing or altering its course and actually going on an easier monetary policy until something breaks, my own view is that we are headed for a double dip recession. A double dip recession means, one recession followed by another one, and therefore you actually have sustained long periods of weak sentiment and weak stock markets performance. The last time this happened was in 1980s. You can see in this chart that there were multiple readings of negative GDP growth and multiple recessionary dips between 1980 and 1982. I think that's where we are headed. What does that mean? Well, that means that there should be no rush to get into stocks. We are headed for a lot of volatility in the market, a lot of ups and downs, and investors, whether they are professional or first time, can actually wait before they get into any stock market positions. Thank you. You can follow me on my Twitter handle at @1RajKamal and Instagram at @1RajKamal. Thank you.